Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So the agenda today, I'll go through the regular market update and Sean's going to talk a little bit more about those long put butterflies. Just kind of a heads up for the coming weeks. Next week I'll be going through a review of the quarterly studies report. I think Sean's also going to be touching on some of the earnings results. And then the week after that, we're right back at it with the next earnings plan. So that's the next couple of weeks. So let's get started here. Okay, for market overall, you can see our indices have all remained in the same states here. Highs, we've been kind of going up and down. I think we're down from last week, right around 32% bullish. Just been very volatile as we've talked about. So let's take a look at the market pulse. So as far as state 1 and 8, we had a drop down, but we've kind of rebounded up here in the 40s. Obviously very bearish when we have so many stocks in state 8. State 1s really haven't been doing much. A lot of things getting dragged down overall, down into the 4s and 8s. So we barely have any even 2 right now. So let's say majority are in 4 and 8 here, and some are bounce back into 7. So quite a big shift, from the beginning of the year, when it did cross here the 18th. When we look at the new lows, we had that initial spike up at the end of January. We had another spike on the 24th, had a big drop off. We had a big bounce on that day, very volatile day, when Ukraine was invaded. So we had a big drop in the lows there, around 100. Wouldn't say quite, a flat line level, but it's built up a little bit more. So you can see we have these big spikes, a little, lull in between, another big spike. So I think until the market kind of figures out a direction, we can expect more of this. And that's just, talking about more volatility going forward. With the Fed meeting in 2 weeks, 2 weeks on the Wednesday, our market moving day. So, that'll be a big thing, I think in a couple weeks here. And we'll go into see what the expectations are in a little bit. As far as, bullish bearish, just kind of been, flapping back and forth here. No real sustained movement down or up, kind of in that, with that high water mark around almost 80, with that initial spike, kind of came down, but we're still in very, 60 range, 60 up to 70, and now, mid 60s. Obviously an up day today, but still not real big movement one way or the other. So just goes to say, market's trying to find its direction here. Let's take a look at the Fed real quick. That Sudhir found for us. So we've been monitoring this on a weekly basis now. Initially it was skewed towards that 25, and then it popped up where the 50 was about 70%, and then kind of came back even. And now we're at 99.8% for a quarter rate hike, 2 weeks out, and all the 50s are gone. And, not really much here on the no action, 0 raise. But pretty much right now, they're all saying quarter point hike. So that's kind of what the expectation is right now. And I would say we can pretty much count on that right now, outside of any geopolitical events, something happening in Ukraine or something like that. So.
Powell just testified in front of Congress, and that was he said he supports a quarter point hike.
Yeah. So, and he's, they're going to be cautious, I guess, on their movement. So we'll have to see how that pans out here. But it looks like it's quarter rate hike guaranteed overall for the market right now.
Yeah,
So,
I think the message there might be, if it's a quarter rate hike, you probably won't see a big reaction in prices of the indexes thereafter. But if it is something other than a quarter point hike, you see maybe extreme volatility the day after, is the way I would view that. And, as far as the Fed fund rate goes, I think I said before, it's good for maybe the next meeting, but when you try to project 2 or 3 meetings out, you can see how much it moves in a matter of weeks. So
yeah,
it's a pretty volatile index. I'd be interested to see how volatile it is compared to the VIX, for example.
well, you can look at the May, it's pretty much banked on another quarter hike there. Same with June, so they're looking at quarter rates right now with a little potential outside of doing a 50 in one of them possibly, but they're just looking at quarter rate hikes right now. So I think the other part of that is what are they going to do with the assets? They're trillions of dollars on the balance sheet. I think that's a little bit unknown, but I think Dave's right. I mean, if they do anything outside of those expectations, and you could see a lot more volatility in the market. But I think any language about what they're going to do with their massive book of assets, I think that can move markets a lot too. So I think the expectation right now is runoff. Let things expire and not re-up on any purchases. So that'll be, I think, the big thing outside of, if they do something outside of 25. But I think the balance sheet's kind of the focus right now. So as far as SPX, I think last week, we had talked about there's no good news going out there. We had that huge drop off, hit down to that target 3 and pretty much bounced off of that. And that we're kind of in the middle. I would say, the kind of things we want to watch, right now, this is our resistance level. You can see here, it turned into support. And then once it broke, kind of retested right here, had a big drop down. So this is going to be our, as far as state modeling, our resistance point right here. And, as far as, going up, this, obviously the entry price, and then, the big one will be this 4160 for the resistance. We're still in state 4. We've been in there longer than expected. Obviously very volatile state 4, as you can see here, but I think we're getting pretty good help as far as support and resistance levels from the modeling. So we'll have to see how long it stays in there. I think it'd have to, I would expect it to have to break that 3 to get into 8, break below there and hold, or I think if we also look at the charts here, I pulled up the Fibonacci. I did it since that March low in 2020. So you can see, back there, that initial drop in the, when we had that big spike in the lows, it got near that first level. sorry, the percentages aren't on there, but I think it's 23. Let me see if it's on this one. Yeah, 23. So it got down that level, bounced back up. And I think the key thing here is that 50-day turned into resistance. It was support for, over a year, pretty much from that bottom. You can see there, we can also see here, try to get up in that range and really turned around. So I think this is our key level, that 50-day. We're also below the 200 right now, so that's another thing to watch. I think the 50 is a little more important at this point, but you also want to keep your eye on that 200. So the 50-day, as of yesterday, was 45, call it 40, and then the 200 is 44.60. So those are going to be resistance levels on the way up, and then obviously this 4,200 kind of area. That first Fibonacci is going to be, your resistance on the way down or support for bullish. So that's kind of your key levels for the SPX. I think that 50-day is going to be hard to break above right now, but we'll have to wait and see. Also on SPX, I've kind of pulled this up. I showed you last week, but the key thing I watch is this like MACD. You can also watch stochastics, but I kind of watch the MACD a little more. So February closed out, and you can see on the left there, the signal line's getting pretty close. 0.74. During these up runs, you can see it's like, I'm looking at this number right here. 8, 8, 6, 7, 5, and then so now we're pretty much really close to crossing. And March, obviously, we got a lot of time left in March, so this can change a lot. But if this crosses, I think we can expect kind of what happened with IWM, talking about getting down to that at least the middle range in a few months following that cross. So that's something to keep your eye on also. So that kind of covers the SPX. Let's look at Russell. Once again, Russell, this modeling has been, I'd say, very nice. There's your resistance, and then your support hit twice, right? Pretty much within like $3 and bounced off dramatically. So, those are your key levels as far as modeling the watch. When we look and take it to the charts, you can see those real big drops right on that Fibonacci level. And then the pop is right on the top of that Fibonacci. So you got those Fibonacci's pretty much mirrored right here in the modeling. So those are your really key levels. I still think, that 2100 is the upside there. And that was our channel, the bottom of our channel for quite a bit of time. Let me pull that out. So, from January, kind of when it started of 2021. So we had this channel the whole time. So now that we're below there, all right, there's people still joining. So once we broke below there, we tried to retest it there, turned around immediately, and the same thing on the bottom side. So, this looks like it's channeling in here, and we'll have to see which way it breaks. You got your 50-day cross below the 200 here, January 18th. So I think that was before our low spike, right? What day was that? Yeah, that cross was a few days below, our new low spike there. So as long as, the 50 is below the 200, excuse me. It's an overall bearish sentiment for, IWM. Key levels to watch. Obviously, that 2100 is critical to the upside. So, if it gets through there, holds, that'd be very bullish for the market. If not, you can expect retests of this lower level here. And if we break through there, you can see the next level down is 1700, the bottom of that channel. So that's kind of the key things to watch here. I think it was very interesting how those things hit right on the Fibonacci's, which pretty much modeled, that target 2 here and, our stop loss level. So this has been very interesting modeling. I'd say very accurate. Obviously, we're 25 days in, so getting close to what the average days are. Didn't quite hit, I would say, what is the average move? Average move would be in between target 2 and 3, which is going to be 10%, which will be right down around this level. So that'd be like, just call it 1800. So something to look out for. That 1800 obviously is in the middle of the next Fibonacci. So hard to say exactly what happens. A lot of geopolitical stuff going on over in Ukraine. I think if that escalates outside of Ukraine, obviously the market will react very negatively to that. So, a lot of things, a lot of volatility going on in the market. I expect that to continue. And I don't know if you guys watched the 10-year. That thing has been kind of popping up and down, pretty drastic moves. It was over 2. Let's pull up the, so we got up over 2, dropped all the way down to 1.6 something, popped way back up today, very volatile as far as the market. So, I tell you guys, keep your eye on this. I think over 2.5, it's going to be a net negative for equities at this point, the way the, the Fed is positioned. So we'll have to just wait and see how the yields go. I think the big thing for the yields is, after the Fed in the next meeting, they can keep buying assets up until 2 weeks from now. That's what they said. So after, that meeting, the backstop for all these treasury purchases and mortgage-backed securities is gone. So it's going to be a lot more open to the market. So that'll make things a lot more interesting in the 10-year and all the other government bond markets. So that's a couple weeks away. Until then, they're still accumulating, providing a backstop for everything there. So I'll open up to questions, comments for the market. Feel free to unmute yourself and chime in.
This is Dave. I'll give a quick comment here. There's a couple things I'd be curious to, hear what other people think about maybe the impact of whatever their interpretation of the State of the Union address was, going, long-term effect of that. If anything, that's kind of, I'd be interested in that. I just wanted to connect the dot things. And Friday is the jobs report, and the impact on the Fed's fund rate. If you think that is just a reflection of the current view of inflation, I think maybe that's not entirely correct, because I think the geopolitical situation has impacted that probably more than anybody's current view of inflation versus what they had 2 weeks ago or a week ago from then. Now with the VIX at 30 still, that sort of implies that trading options favors the sellers versus the buyers. I don't know whether there's any new trading thesis that have evolved since the, the impact of the war with Ukraine. There is one thing that I found, I've been listening to over the last week or so that might be interesting to post. Dan put out an email on implied volatility, and I responded to all. So I'm not going to talk about that now. I mean, read that to your leisure. I'm assuming, Dan, I think you're on here, that you sent that to everybody that's on today's call or could be on today's call. So if you got Dan's email, you got a reply from me on implied volatility. And one of the things that was interesting that I just found out is I was not aware that there is a.
You're cutting out, Dave.
I'm sorry.
Sorry, you are. I think you were talking away from the mic there.
Oh, sorry. Maybe I just turned my head slightly. But there's the VIX, which is like the year view of the VIX, or where VIX is today compared to where the high and low for the last year. There's also a VIX 3M. I think that's what it's called, VIX 3M. That's a 3-month view. So it's kind of like a quarter snapshot versus the year snapshot. And typically they go, when VIX goes up, the 3-month view goes up too, but there was a divergence where the year aggregate of VIX was higher than the 3-month of the shorter view, kind of like a backwardation if you're thinking about like that kind of thing in a commodities trade. That was interesting. So then that was like just popping up lately the last couple of weeks, where it hasn't popped up hardly at all, where there's this divergence. So it might be interesting to take a look at the 3-month laid over the top of an annual VIX kind of chart, if you will. So I thought that was, and those are S&P. That's of course the volatility of both are just of the S&P over those time frames. Anyway, just thought that would be that was kind of like I didn't know that ever existed, and kind of brings into light the changes in VIX over 2 different kind of time periods. I know that. Anyway, just thought I'd throw that out there. And if it was a long-winded reply to Dan, so if anybody has questions, just call.
I'll chime in on one thing real quick and let others follow. The inflation front, obviously, if you look at oil, we talked about that quite a bit. That's spiked up significantly. I went out last night and the gas prices here were like $3.59 immediately across all stations. So that's kind of weird how they all had the same price. But I think the other thing, Ukraine is actually a pretty important country as far as like production. It's like the breadbasket of Europe. I don't know if people know that, but I have some stats here as far as that. Ukraine can meet the needs of 6 million people for food. They're the 5th largest rye producer, 4th in corn exports in the world. They do barley. They have the most arable land in Europe. And that doesn't even talk about their natural resources. I think, they're first in Europe in ammonium production. So that's for, growing crops. 4th, let's see, just a lot of stats. I mean, they're actually very important as far as like food production and natural resources. 3rd largest iron exporter. They're very important. So I think we actually should care a lot what happens with Ukraine just because of that. I don't know if you've seen, like, I saw like on the futures market, like wheat gapped up, limit gaps gapped up the past 2 days. So all of this is not going to help inflation at all. Oil, not only transportation costs, but all the products. that it affects, I think there's, 3,000 products that come from crude. All of that is going up. So that's not going to be good for inflation overall. Just kind of wanted to point that out. But anyone else have rebuttals or things that
Yeah,
are?
hey, Josh, it's Lee. I've got an add-on. I know there are two rare minerals, and I'll say plutonium, but don't hold me to that,
Yeah,
that are used in manufacture of computers and computer chips. And they're like a leading supplier of those. So that's just piling on to what you've already shown.
yeah,
Anyway, for what
They're a
that's
leading supplier of neon gas that's used in semiconductor manufacturing.
there you go.
yeah. I mean, it's just this laundry list of all the resources they have. I mean, it's incredible. Yeah, they're very important for the market and, natural resources and food. So,
Josh, this is Joe.
yeah,
Dave asked about the any possible impact of the State of the Union. My take on that would be that, that speech, I think, annually is just political theater. I would not attribute today's market rally to last night's speech in any way. I just think, we're in historic geopolitical times here, and everybody's been talking about the volatility in the markets. I think that's just going to continue. One thing about the speech last night that got applause, that struck me as unnerving a little bit, was when the president was speaking about further isolation of Putin, and that's kind of what we're doing. We're isolating him more and more. Nobody knows his state of mind, but it certainly seems, somewhat maniacal. And, to back him into a corner, I don't know what the answer is, but I find that very unnerving. So, like I say, I don't think the State of the Union really had any impact whatsoever on the markets. And just, talking about the whole rate thing mentioned a couple of weeks ago, I might just still keep an eye on, a few of those, like the TLT, the 10-year, the IEF, those symbols, they're all still in state eights. They've been in them a lot longer than usual. May just keep an eye on them. And then something that struck me too, just trying to equate kind of the move in rates from a state modeling perspective with maybe the XLF, the financials. It's kind of interesting. The financials are struggling a little bit here. Not that they're falling out of bed by any means, but they're kind of under pressure, and be interesting to see if we're able to get a market rally out of this point with potentially the financials, going down. That would be somewhat unusual. So just a couple of things I'm looking at.
Joe, this is Dave. I just wanted to not rebuttal, but comment on that. That's kind of where I was going on any trade thesis developing out of this. With sanctions and the finances, I mean, that's where the impact on Russia's going to be finances, right? So banks, are now shut off from dealing with Russia. As a matter of fact, the credit card companies, Visa and MasterCard, said, we're not going to process any transactions that are, come out of Russia. It might not have impact on the S&P, but it might have things in the repercussions that impact industry groups in a pretty serious way. And so if a bank is doing business with Russia and they can't, and they're trying to pull out, some of the European countries are a little more at risk than the U.S. Take BP and Shell, for example. They're trying to get out and cut ties with Russia, but they've got, how do they sell assets there? They can't. And so those are things we're hearing about now, but we won't see impact probably until we get financials of the next earnings report that, comes out, if one just already passed, or the banks have already passed, right? They were to announce in the earnings season. Jamie Dimon came out and said, well, this is, might not be good for us because, as banks, we have to deal with the globe here, and now we can't. So, I don't know whether there's a good up, down, or, maybe we're at the bottom, maybe we're at the, I don't know. I don't play too many banks, but think
Well,
about that. Where your positions are might impact you because of the finances of our response to it. Just saying.
But a very fair point. And, back to that XLF, about 36% of that index is tied to the banks directly. XLF went into a bearish state last night. Now it's not an 8, but went into state 8 last night. So that might be a half decent proxy, for, getting into the weeds like you're suggesting. What's the direct financial impact when companies like you just talked about, shut off the switch. So might be a good proxy to keep an eye on.
All right. Yeah, just another comment on what Joe said about Ukraine. I think, at the beginning of this, Putin basically warned about any interference in it, or, sanctions and things like that. So they've already put sanctions on. So, I mean, it just seems like there's a lot higher probability of escalation than de-escalation at this point. And I think that's the worrisome point. It's hard to imagine this thing dying down real quick, especially as, more and more things are being, taken away from the Russians. So hard to say, how Putin's going to react. I don't have that crystal ball. It just seems to me like the probability of escalation is, way higher than de-escalation at this point.
If that's why VIX is at 30.
Yeah. So, all right. Anyone else, comments or questions?
Josh, can you hear me?
Yep.
This is Dan.
Hey, Dan.
I'm having a problem with my mic. Anyways, a couple things. I agree with Joe about last night's State of the Union address. I think it was political folly. There were certainly a lot of Democrats making the noise, the applause to all of his bullet points, but that's just all staged as far as I'm concerned. To your point, last week I had the honor of listening to General McKenzie. He's a 4-star and he's the head of CENTCOM here at MacDill Central Command. And he was, there was a panel of 32 people that were asking him questions. And he's 42 years in the military. And he was talking about Putin and the Ukraine situation. And he made a couple of statements. One that kind of hit me. He says he wasn't too concerned at the time about the immediate actions that were going on over there. What he was concerned about was as the sanctions start to hit Russia, start to hit Putin and his friends. He said it'd probably take a couple of months before it really starts to sting. And when that happens, that's when he's a top military leader. He said that's when he's going to get worried because he's afraid that, if you back Putin into the corner and you start poking the bear, that, in Putin's state of mind, you don't know what he's going to do. And he's certainly made some pretty nasty threats to to us as far as using nukes and things like that. He made a couple of comments. One was, if there's no room in the world for Russia, then there's no room for the world, or something like that. And he put all of his all of his nuclear people are on standby, and there's also nuclear submarines off the West Coast, and they can launch 500 nukes. His fleet can launch 500 nukes. So he's really spreading fear, into the world, basically. So I think he's a psychopath personally, but for him to do what he's done, it's just awful. But you can see why, just to the points made earlier about all the resources that Ukraine has to offer. That if he can successfully take over the Ukraine, he's going to have all those resources. So the other thing that I just caught it briefly last night, but because of the sanctions, there's some of the economists are worried that this could also roil the markets. It can have a reverse effect, much like Lehman Brothers. It can cause a credit problem, like with Lehman Brothers, and that could also roil the market. Let alone with the inflation that it's going to cause. If it goes into like a broad Lehman Brothers scenario, that can really cause a lot of problems with the market. So, yeah, I think this, the volatility is going to be here for quite a while. And as you can see, this has been pretty dramatic, So I see these up markets like today, and it's been like clockwork. It'll probably be down this much tomorrow. So.
Yeah, definitely
hello.
seesawing. Go ahead.
This is Jean. I listened to it last night too, and I'm wondering what people's opinions are about the. I can understand the sanctions, but if it's going to take 2 months, there will be no more Ukraine. I don't think it'll take that long to wipe them out completely. That's my opinion. But also, Zelensky is begging for the no-fly zone, which Europe and the US won't do because they are afraid of Putin going off the deep end. So I think that that's the only thing they think they can do are the sanctions on the Russian people in hopes that they will at some point rise up and put more pressure on Putin also. Also, I don't understand why if we receive somewhere around a quarter to a third of our oil and gas from Russia, why don't we stop that? I think that's part of the sanction, but also start redeveloping our own reserves and pipelines so that we have our own energy again. Are there any comments on that? I'm just confused about why we receive so much oil and gas from Russia. Comments?
Well,
Gene,
somebody
this
can
is
make
Joe.
money by buying it from there cheaper and reusing it. So it's a matter of money, in my opinion.
Well, I mean, we have our own reserves, Dave. So I don't get it. We
Well,
should
that
be
gets back to an environmental problem, though, Jane. So,
well, the environment right now is not exactly priority as far as I'm concerned. We've got a potential for war. There won't be any environment if things don't get settled down. And yes, the sanctions need to go in place, but what are we going to do for gas if they sanction the oil and gas that we're receiving from them? So where do we
fuels
get
is why Russia has leverage right now in Europe. If Russia did not have that leverage in Europe, there would be, more pushback against Russia. It's fossil fuels that are part of the equation here on.
I know it is.
The dependence on Russia. So
yeah, Europe receives 40% of their energy from Russia. So if they sanction that also, then that's going to cause them a lot of stress. We'll all be deficient in energy if we're not receiving anything from them, but we need to develop our own resources to get him off of our, backs with that kind of stuff. But I don't think we're going to the last 2 months without any more help.
It's Joe. I was just going to say, I think one of the biggest impacts of the change coming out of the last presidential election, was obviously, the focus towards the disappearance of fossil fuels. And, there's certain element in the party, obviously, that wants to do away with it yesterday. And, you know, the abruptness of that change, I think, has really had an impact on, you know, our whole energy situation. And
Yes,
this is one, and obviously Putin saw that, and
yes.
you know, I think has reacted. But you know, politics is just so important, you know, to the markets, to our day-to-day lives, and you know, to psychology in general. It's politics is everywhere.
Well, that's true, but right now we've got a war that's going to wipe out Ukraine, and then where does he go? You know, what does he do? It's scary.
No one knows. Yes, it sure is.
I do have a comment back on the market.
Yes,
I don't have an opinion on how to solve all the world's problems on this call, but back on the market on an optimistic note before, just listening to everybody, I'm almost ready to hang myself. So on an optimistic note, one of the things I notice about the market is it bottoms when people are most negative. And as an example, during the COVID crisis, the market started dropping exactly on February 24th. We didn't go into full lockdown. I know the exact date because I was at a family reunion. We didn't go into full lockdown until March 16th. And the market bottomed on March 24th. Just 1 week later, it started to go up. So my point is, we went into full lockdown. Everybody was really negative during the COVID thing, and the market hit bottom a week later. And as you know, in 2020, went up quite a bit. So I don't know why, but the market may sense that all the bad news is priced in. Maybe when Powell comes through with the 25 basis point hike, and that, people may feel like, okay, we've got everything priced in, even a bad outcome in Ukraine, and the market may shift upward when everybody's the most negative. That's what I've seen happen before. And maybe looking for
you better start doing your prepping anyway before the shelves are completely empty.
Yeah, I mean, remember the market hit all-time high on January 4th. Today is March 2nd. So we're almost at 8-9 weeks of a drop. And I agree with all the comments. I don't have any solution for them. And the picture looks bleak, but I have noticed that the market tends to reverse when everybody's really negative. So be prepared. Maybe we're hitting bottom. I don't know why.
And Sudhir, trying to quantify that psychology. I mean, psychology is just so critical to the movement of the markets. And, if you go into like the AAII weekly survey, it's bearish as can be. And to your point, maybe, and thank you for the optimistic, comments. Who knows? Maybe we are trying to make a bottom here.
Yeah, I mean, what I plan to, as I've said, I kind of sat on the sidelines on the earnings plan and everything this quarter. But if Powell comes through as he's supposed to, as the forecast comes through, and things stabilize, I plan to do the studies and the earnings plan in the next quarter. I think the market will find a bottom here in the next couple of weeks. And once again, I don't know why it does it, but statistically, the AAIA survey is a great indicator. When everything is the most negative, which it is right now, the market finds a bottom and starts moving the other direction. I don't know why, it just does.
And that survey is at its most bearish point in the last year right now.
Right, I've seen it. They've mapped it many times.
well, those are all interesting points, and you'll definitely appreciate the great, comments and discussion. And I think we'll turn it over to Shawn right now. Hey.
Hi, Shawn,
Yeah.
give us something very positive.
Yeah, right. I was scrambling not to talk about what I was going to talk about, trying to find something better, but I can't do it. So I don't know. So I'm sorry. But no, so what I wanted to show is I did, we had a decent amount of people. Let me share my screen. We had a decent amount of people on this call, on the brief call that we had last Friday. So I just went over the long put butterfly trade and just kind of how the virtual portfolio, how to use that with the current environment and what we've seen in the charts over the past couple of weeks. So a lot of people joined that call. I did share that video. I downloaded the Zoom video, shared it, on, the email via link from YouTube. So again, that link's private, but if you have the link and you share that link with somebody, they can view that video as well. So I did want to ask first and foremost, anybody that had seen the video or anybody that was on the call last week, are there any questions relative to that strategy, or anything relative to the long put butterfly trade? So any questions, comments? All right, fair enough. So that means it's,
I'd like to talk about on that when you get to it.
yeah, fair enough. Yep. And I have a couple back tests, and I'll kind of review over that briefly as well. This is kind of what I just wanted to show you guys too, just another little tidbit of the platform. Joe was talking about briefly, the XLF, the ETF. So we all know, hopefully, that we can go into the ETF overview within the platform. You can type in the symbol of the ETF. You can go and look at the holdings, and this will basically give you all the holdings that are comprised within that XLF ETF or any ETF that you want to put in there that we have within Delphian. So you can see, what stocks or what symbols take up a certain portion of the ETF. Here you can see JP Morgan is at the top with about 11% weight. And you can also add all of these stocks individually to a stock list if you wanted to do that. And then you'll just have a stock list that's comprised of the 67 different symbols that make up the XLF. And you could, use that to maybe, run further analysis within the screener by pulling out, what state are they in, what price move have they made recently, just all these cool different things that you can use that stock list for. So, always, if you think of something that you want to look at, you can always kind of, do some further analysis within Delphian to do that. So back on the back test. So I did run a couple of back tests. So like Sudhir mentioned, last week when we talked about the, long put butterfly, there was an issue in the coding within Delphian for the long put butterfly trade. And really it was relative to the actual balanced portion of that trade. So if you go in and you set up, a specific trade rule, for the long put butterfly or the long call butterfly, you can always set up your strategy. So your strike selection model here, you can set it up. And like Sudhir mentioned, you basically are buying one, selling two, and then you can use the equal distance between that area by using this balance function that we have here. That balance function wasn't working properly. Now it is. So not only is the long call butterfly spread working properly when you're putting into the trade rule, but the long put butterfly is as well. So those are working great. This is great for what I was using them or what I needed to do. But as far as the back test, we talked about it on Friday, really trying to find some really good entry points, meaning what is making Sudhir or what is making anybody else want to use this long put butterfly as a hedge, to their current portfolio. What is going to be your entry point? We all know when we're setting up a back test within Delphian, you have to have an entry point. And for some people that can be a sticking point because it's like, well, I just want to get into the trade. Well, the computer doesn't understand what that means. So you have to specify it. And to that point, I really myself have not found, since last Thursday, I started kind of running through this, and I haven't spent, every waking hour trying to do it, but I try to think about some good entry points. What would make me want to do it? And can I quantify it by using a signal within Delphian? And I've used a couple, we've talked about Keltner channels in the past. So I've used Keltner channels here, as you can see under this entry exit date column. These are all the back tests that I've done just recently over today and maybe even on Saturday. But I use Keltner channels. I use some bearish states. I use the bearish states with targets. I use all these different things. I tried to run that and see if I could somewhat just come up with a good range of entry prices or entry points for a back test to use that long put butterfly, and I used it on the ETF. So I used it on just 3 ETFs. I used it on IWM, SPY, and QQQ. And really, it didn't produce, any good results that I would want to show you as of yet. If I find something, I'm definitely going to share it with the group. But I didn't find any good results, or at least any results that were making money to the downside. So that being said, Sudhir, did you want to mention something on something maybe you had found or something you were thinking about?
Yeah, so I did once the balance thing started working, I did a number of back tests using the MACD entry signal, which is the MACD histogram declines 2 days in a row. And another one is MACD histogram declines 3 days in a row. The MACD histogram declines 3 days in a row doesn't work very good. But there's one combination with the MACD histogram declining only 2 days in a row that was profitable. It wasn't very profitable. It had a profit factor of 1.06 and a win rate of just 44%. But one of the things that the back test does is if the MACD declines 2 days in a row, on day 3, you'd put in a butterfly. And on day 4, if the MACD keeps declining, you put in another butterfly. Whereas my rule is you don't put in a butterfly if one is active. So I don't have the button. Josh showed it once that, only one active trade per, I don't remember what that button does. You remember what I'm talking about?
Like a simultaneous, right, where you can have
no simultaneous trades. I don't have that button. So this one does simultaneous trades, and I think if you don't do simultaneous trades, which is actually the way I do it, then the losses would be reduced because you don't keep getting into a new butterfly every single day if the previous butterfly hasn't closed, right? And but anyway, the one that was profitable was a 75% profit target, 75% stop loss. Now, in order to do it manually, okay, I went back and I just manually, in a virtual portfolio, went back 6 months. I went back to September 1st and manually, day by day, stepped in, looked at the MACD, entered a trade, and of course, didn't enter simultaneous trades. And in that virtual portfolio, I used a 50% target and 100% stop loss. And that virtual portfolio for 6 months, where I did it manually, was up 19%. So it made 19% return on capital when I do it manually, but I can't do it because I can't eliminate simultaneous trades. I can't duplicate that in the back test.
Right. Okay.
So that,
and what is that just using the SPY?
What's that?
Is that just using SPY, SPY?
Oh, all my stuff was just on SPY.
Okay,
I didn't do it on all 3. I just did all of these on SPY just to kind of see what would work. So I think it might work when I do it manually in the virtual portfolio. It works, but the back test, because it does simultaneous trades, doesn't duplicate that.
It won't duplicate it, yeah. And that's the thing. So I'll have to run it on the MACD histogram and see if I can run it with the simultaneous or without, and see if that, like you said, what that produces, since you don't have access to that one. But that was my issue on some of these back tests that I have here. The bearish ones were that, I'm getting into it almost a day late. The drop had happened, and then I'm getting the trigger to get in, and then I'm missing that drop from that previous day. And I think, like you and I spoke about on Saturday, I can't figure out a way to capture that without just arbitrarily doing it, and then we're just taking the whole automation behind it and really just trying to step ahead of what the backtest is showing. And I don't think there's a way that you can automate that without, I just think you're almost picking out the best trades at that point. So it's not automated. So I'll have to look at the MACD histogram and see. I was just using those Keltner channels here. So yeah, that's interesting that you did that.
Yeah, and like I said, the virtual portfolio, when I do it manually, it works. It works.
Yeah. Okay, fair. Yeah, I'll have to see if I can replicate that and see.
But
if
I
we
only
can
went,
find
but
something.
my back test went back to January 1st of 2020. Because of course, the computer's doing it. With the virtual portfolio, when you're entering trades manually, it's a lot of work. So I only went back to September
Right.
1st, right? So I only
Right.
did 6 months in that, but that still took me a couple hours to put in all the trades and step through every day. And,
Oh yeah, definitely takes a while.
So,
So yeah, well, good. I'll try to replicate that and see, and then if we can, if I share it with you, and then we want to share it with the group too, that we can do that next week, or at least we can do it via email and kind of share it with everybody. So that would be perfect.
yeah,
And then I think we've talked about it too. It does happen so fast to the downside that I was able to replicate kind of the KC cross above. So instead of using the long put butterfly, I tried the long call butterfly, and that one I was able to get it profitable by using a little longer term options versus just the weekly options that expire in a couple of days. But again, it was slightly profitable. And, I feel like on the upside, like we've talked about, the trend on the upside seems to just take a little bit longer to form. So you're kind of getting that slow rise in the market versus getting that big, quick drop like we do, excuse me, on some of these downside trades. And obviously we know, the market's been, steadily rising over the past, years. So the call side or the upside is going to be more beneficial typically. So.
Yeah, I got a question. This is Dave, and I apologize. I was not at the last meeting or not available Friday, but I will watch the replay. But a quick question on the trade idea are the strikes, how far out of the money are they, and how far, what's the duration that you're using for the idea here? Short, month?
Yep. Yeah. Short, and I'll kind of show it. So here, I was going to show it real quick, because we had talked about the strategy last Wednesday, Dave, and then a couple of people on the call wanted to kind of go over the strategy a little bit in more detail. So I decided to do like a Friday call just to kind of give everybody a heads up. And the reason I did it, and this is for Dave, I think everybody else already kind of knows, but Josh had given a particular sample or an example, of the Fibonacci retracement and the possibility of the SPY, dropping down below 300 or 400, to around 380. And when he was talking about that, I was able to look at this chart, recently of the SPY, and you can kind of relate what possibly is going to happen over the next couple of weeks or months to what has happened, in this time frame here, January 4th coming down, going back up and coming back down again. So really being able to take this setup here and mimic your trades within the virtual portfolio to analyze that trading strategy, that long put butterfly strategy, to be able to see what is the trade going to do in this environment, what would it do here when the market goes back up, and as a trader, how would you react to that particular setup? So that's why I did that call on Friday. But what it is essentially I'm going to show everybody. So if I go back to Friday on the time machine, I want to go into my virtual portfolio, and I'm going to set up a trade and show you guys, just again, that trade setup real quick. So if I go into the long put butterfly that I have set up, so it's really short-term trade, Dave. We're talking about the SPY. We're really just using it almost as a hedge, to the downside. So the long put butterfly, if I go into add a position, I'm going to, again, type in SPY. And this is for everybody, too, to kind of look at that trade setup from when we talked about it on Friday. So I would go in, pull up the long put butterfly. So what Sudhir's talked about is using, since SPY has 3 different expirations every week, a Monday expiration, Wednesday, and Friday, you can do it, however you want to do it, really, just whatever is going to give you the risk to reward scenario that you're really looking to capture. But let's just say last Friday, we wanted to do one for this Friday's expiration, which is March 4th. So we'd look at March 4th. The close of that previous day was 436. So we're doing the put side. So let's do a 436 put. We're going to buy a 436 put. Sudhir talked about using the standard deviation as your basis for the 2 options that you're selling. So we're going to use the standard deviation for that expiration is 422. So let's go 1 strike above the 422. So then we'll go to 423. And then we're going to keep this balance. So, we have 13-point difference between these strikes here. So then we're going to go 13 more points down, which would take us to a 410. So what we're doing here is we're basically buying a 436 put, selling 2 of the 423s, and then buying the 410 put as protection. And we can see down below, this gives us this risk graph here, which is set up perfectly. We're risking $208 on the trade. Our max profit again is 15 points, but 15 points minus our cost, or excuse me, 13 points. 13 points minus our cost takes us to the 1092. And we can see our break evens here as well. So our break even is between the 433.92 range and the 412.08 range. That's our break even. That's the window of price where we're going to make money if we hold this trade to expiration. And we've talked about it not holding this trade to expiration. Typically, you're going to want to set up a parameter of what's going to be the profit scenario that you're looking for in this trade. Sadir has been looking anywhere from between 25% to 100%, trying to find that sweet spot, and that's really where we're trying to, make a good analysis on the back test to where we can back test it and come up with the most optimal, price point to get out. But we can see here, this setup is how the trade would be set up again, using the closing price, using the standard deviation, and then just wanting the trade to be balanced on the opposite side. So if I save this trade, then we can see it's going to be in my virtual portfolio. And then as we know, the market itself, opened up down, it opened up somewhat flat yesterday, then it come down, and then I think it started to spike up yesterday towards the close. So if I go one day ahead, so this was Friday's close, if I go one day ahead, March 1st, the trade's actually at 117, are profitable by 117 bucks. So we can see we have a pretty decent return on profit there, a return on risk of 56 bucks. And then the market's up today. So that goes to Sadir's point of, being pretty nimble, picking that price point, 25%, 50%, and getting out. Because if you didn't get out yesterday when you're up that money intraday, you're probably down money today or flat. So does that setup make sense, Dave?
Yeah, I get the idea, and you answered what I was going to ask next is you don't hold this through expiration, right? Because you got assignment risk.
Right, exactly. Just holding it to expiration, as you know, with these types of trades, really your optimal point is for the stock price, or this case, the ETF price, to close at 423 on expiration, which we all know is highly unlikely. The probability is really, really low. But really in a market environment like this, where you're getting these big intraday volatility moves, some of these trades are able to take, a 30% or 40% profit pretty quickly. And it's a low risk trade. So a way to be able to put a hedge on in your account, relatively low risk, and then still be able to keep making a little bit of money if you do get this spike down. But really trying to replicate, why would you get into this trade other than the fact that, you think the stock market's going to go down because of, inflation or the Fed raising rates or the war, in the Ukraine. And really that's what we're trying to come up with are there reasons why, signals, indicators that would show us why should we get into a trade like this? And like I said, my signals have just been almost a day behind. I'm missing that day move when I would probably already be out of the trade by using some of my entry points. So I'm trying to come up with some better entry points.
Yeah, in this example, I'd be out of the trade because right now I'm setting my target at 50%, and obviously with a cost of 208, you're over your 50% profit, right?
Right.
So I would have been out of this trade, well before export. I would have been out yesterday, well before export.
Yeah, right. And I'm following the trade in the other system live, and it's at 176 now or so. We're talking about 3 different options, so that price could be off a little bit. But if you paid 208, you're at 176, so you're not down a huge amount of money, and the market's at 439. And really, you're long a 436 put. So you're really only 3 points out of the money, on your long put. And you have today, tomorrow, and Friday. And like David mentioned, a couple of reports coming out Friday morning, which obviously could move the market one way or the other. Who knows which way it's going to go. But it's just an interesting trade, that we started talking about last week, Dave, as a good hedge, a good low cost hedge, if you will, to catch some of these pretty decent little volatility moves to the downside.
Okay.
But yeah, I think like
Sadir, a quick question on that. If you're using it as a hedge and you're not planning on necessarily winning most of the time with this trade, so if you're using it as a hedge, why wouldn't you not pick a farther out of the money strike and really take in some dollars if you're right at a low cost entry, like you're saying, Shawn? And isn't that the why wouldn't you go further out of the money than a one standard deviation to try and capture more of a downside pickup? That's what you're kind of playing with the hedge. It's not you're trying to win every trade, right? You're just trying to win big when you win. Or am I getting this wrong?
No, I think I don't want to speak to this here, but the reason I would do it would be what you're saying, right? So you're talking about using, for the 423, you're talking about going further down than the 423 to sell the options.
Maybe that's what I would think if I really was trying to hedge, hedge to a big VIX. I mean, we're at a point in the VIX where volatility is pretty severe here. So if you're trying to bank and win on that, you'd win if you were right and you were farther out of the money. I'm thinking.
Yeah. So it's a pretty big drop, though, right? If you're talking about a break even of what were we talking about? 436 to the lower break even of about 412. So that's almost less than 7% maybe or so. So it's a pretty decent drop to have over a short period of time. And it can happen. I mean, I think my math was right.
Yeah, right, but
that's the whole reason.
I'm sorry, but you're right on that. But the butterflies really pay off when you're right with the strike. So you got to be kind of right at near expiration to win on a butterfly. Yeah,
well, to win in a dramatic fashion, right?
Yeah,
as we've seen yesterday.
Right. I agree.
Yeah, I think as we've seen yesterday, I mean, the market didn't drop that much. I mean, it might have went to 426 or so, which it was. I mean, you're almost 10 points in the money on the put side, but there's still so much volatility that the market did rally back. But even that, with that bit of a drop yesterday, you're still able to get 50% profit on your trade, which is pretty great, right? In a day's worth of time. Well, a couple of days because you had to hold it through the weekend, but yeah, I mean, that's the whole reason I feel that we're trying to figure out a way to kind of put it in the system so we can optimize it that way. Is it better to use, 2 standard deviations out for that sell leg for the selling the 2 options? Is that going to produce better results or possibly a better profit, or what are we doing? This is a trade. I don't want to speak for you, Sudhir, but this is a trade that Sudhir just mentioned to the group that he was doing. So then we're just trying to kind of, take the trades a little bit further and use Delphian to see if we can help, maximize what we're doing. Any comments, Sudhir?
Yeah, keep in mind the days to expiration is very short. You put it in this case for a week. I'm doing a week or less, right? And so you're experiencing time decay, and it would have to be tested. But to me, the first standard deviation is plenty far enough. And I don't plan to hang in there until it hits that number. When it's up, it doesn't take that much of a move in your direction, because remember, the long put is just below the money, right? So it doesn't take much of a move in my direction for this to hit a 50% profit. And I would rather take my 50% profit, and if MACD is still going down, place a new trade, that is one more expiration date out, that is further out. So I'd rather take the profit, place a new trade, take the profit, place a new trade, until you get one where the market goes up and it doesn't work, right? Now, that's just what I think. Like, we haven't found a good way to back test this, so who knows if I'm right or not, but that's what's working for me right now. And like I said, that's what I did manually in the virtual portfolio, and it worked. It was a 19% return on, you have your ROC up there in the virtual portfolio. It was 19% over 6 months.
Right. Yeah, I mean, that's great.
Cool idea. It's hard to model.
Say again?
I said it sounds like a really cool idea, just hard to model.
Yes, it is hard to model.
It is. And that's what we've been trying to figure out. And that was part of the call on Friday too. Really, the Friday call was trying to show, because I've talked a lot about, you can take these strategies and you can find a good strategy, but being able to employ it and using it in the virtual portfolio and then learning from it is very difficult because we can't predict, what's going to happen over the next couple months. But based on some of those analysis that Josh has put forward, using Delphian, it seems like we got, a good possibility of this market pulling down, and it's happened over the past couple months. So now you can go in there and model it and figure out, okay, what would I do and how does this trade work and how does it make money? So kind of set up a good setup. That was the reason for the call on Friday. But more so too is, trying to find a way to model a similar strategy to this, because like, people have mentioned before, a lot of our strategies are bullish strategies, from the studies to the earnings trades, excluding those bearish pre-runners and runners. So really trying to find a way to use some of these strategies effectively within, a pullback in the market is crucial, because it can help everybody on this call, especially when, we're a little bit hesitant. But like you said, Dave, modeling it is another story, and we're trying to figure it out. So if anybody has any ideas, or they are able to go in there and test some stuff and they find there's some good entry points, let's look at them and see if we can, get something together. So I haven't been able to find any way to do it without going in there and, pulling out the best trades, which in my mind is really just, trying to pick the winners, which isn't a good way to do it. It seems like it's going to be a, success, a plan for failure. So if they can find any good ones, let us know. But, we ran over a couple minutes, and, that's kind of all that I had, is I wanted to show you guys, that trade. So that trade from Friday, given the environment and what was going on and the possibility of the market selling off a little bit further coming into Monday from the weekend with the war going on for the first weekend, it just seemed like a pretty good setup, and the trade, like Sudhir mentioned, would have worked. You would have got into the trade on Friday, got out yesterday for a good profit. Intraday, you might have been up a little bit more on the open. I can't really remember. I was tracking it, but I didn't write it all down. And then again, today you're down money, but you're not down a huge amount of money, and you're still in the trade, in theory, that could make you 13 points minus your cost. So you still could make $1,100 by Friday, if the market does pull back. But again, who knows what's going to happen? You're using it as a hedge. So you kind of have to plan on that, being the cost of trading, and you can lose the $200, or if you're risking $1,000, you can lose $1,000 if you did a 5 lot. But again, it's a hedge. It's there for you to make money if the market pulls back. But if the market's up 2% or 3% in a day, you're making money on your overall portfolio, but you're giving back a little bit on the hedge. So
Hey,
that's
Shawn,
yeah.
one other thing, when I did the back test, I don't have the button that says no simultaneous trades. The other thing, I tried doing it the way that I actually trade, which is I set it for the same amount of dollars per trade, dollars risk.
Right.
At 1,000, that failed. So I had to, I don't know why it failed, but so I had to set up the back test for one contract for each trade, which is not actually the way I trade it, right? I trade at the same dollar risk per trade. And when I did the virtual portfolio manually, I could do that. If, like in your case, this one cost $200. So if I'm going to risk $1,000 per trade, I would have had 5 of these contracts. On another time, if the because of volatility or whatever, it was $300 for one position, I would have done 3. You follow what I'm saying?
Yes. Yeah.
So I did that in the virtual portfolio, and the results were good. But in the back test, I cannot get it to work for the same dollar amount. It keeps giving me this error that says, even though I set it at $1,000, that it cannot find a trade, that every trade it found was cost more than my maximum risk, which just cannot be, right?
I understand. Yeah.
So I don't know why.
Errors. Yeah. So instead of putting that one contract. Go ahead.
Yeah. So there were 2 things with the back test that were different than actual trading, which was that I couldn't do the no simultaneous trade, and I couldn't do dollars per max risk per trade.
Yeah,
Yeah,
hey,
correct.
John, I got this. Yeah, hey, sit here, that, that dollar amount is actually the minimum right now, so that's something we'd have to build out, like maximum. You know, ideally, I think we want to be able to say, okay, we want a risk range, so it'll give you multiple contracts. You know, one is $200, one's like 1,500. I want a risk range of, you know, between 1,000 and 2,000 or something like that. So that's something that we'd need to build out. The simultaneous, the functionality is actually being worked on. You know, it's not quite right now, but they are actively working on that. So the other one is, you know, I'd say a down the road type thing.
Yeah, okay, that makes sense. So that was just the difference between the back test and what, you know, I actually did in the virtual portfolio, so.
Yeah,
Kind of
yeah. I mean, we obviously want to make the back testing as realistic as possible, which is why we're eventually going to get that 20-minute data, you know, and things like that. So
Yeah, and I don't know how other people trade, but you know, obviously I've been on the call for a long time, and people know I prefer to have the same dollar risk per trade than rather than do it, you know, like one contract per trade, right? Regardless of how much that costs.
yeah,
So to me, that makes more sense, but I don't know what other
Cool.
people.
Yeah, I agree
I
with you on that. The risk amount per trade, and that as part of your plan, right? Being able to get in for a certain amount, you know, and if it's too much, then you have to, you know, pass on it, because like you said before, too much risk, obviously, that's the one you're probably going to lose on, right? And then you just wiped out a bunch of the gains, you know. So having that plan is huge. All right, well, yeah, I'll try to replicate some of that too. I'll use that MACD histogram to here, and you know, I'll send you some results of something if I come up with, you know, or I'll send you the results either which way, and then we can kind of analyze it further. So, and yeah, and that's all I had, Josh. So thanks everyone. I appreciate you guys listening and taking the time.
all right. Thanks, Sean. Just another, I guess, a couple quick things real quick. I just want to point out, you know, we do have, you know, there still are things transitioning in state one, and I think it's a good idea to just keep an eye on them. You know, see which sectors are, you know, Hormel, so that's like food, gold, you know, transportation. That's another gold one. You know, this is materials, so it's just, you know, valet. So just a good idea just to see, you know, which ones are transitioning along with, you know, like the ETFs. You know, you can try and get an indication, you know, maybe materials are starting to, you know, come back here. So just another thing to, you know, think about on that. And the only other one, you know, we posted this, the new low spike. So, you know, obviously, you know, there's a lot of volatility. You know, this kind of mirrors what we're looking at now with ours, you know, the 1,500, another 1,500. So, you know, just kind of go back through these. It's on the share drive. You know, you can expect a lot of the volatility, and this is kind of where we're getting it from. You know, the all clear would be, you know, this flat line and new lows, or, you know, like this drastic drop with a flat line and new lows. So that's kind of what we're waiting for, you know, until I start seeing, you know, signs of that where, you know, the state eights are dropping, or, you know, we're getting crossovers, or like, you know, kind of steady movements down. Till then, you know, I don't think we're in the all clear. So, I mean, at some point we should be in the all clear, and you can see those here, these flat lines, for an extended period of time. You know, I think until then, you know, we get these huge, I mean, you can see like we had, you know, you pop up, you drop way down, pop up, drop way down, pop even further sometimes. So, you know, just be careful. You know, once we feel we're all clear, we'll put that out, but definitely not that feeling right now. So just wanted to show that. So thank you all for attending, and we'll see you next week.
Thank you, good meeting.
Thanks everybody.